Earnings alert this morning. Disney disappointing investors with its fiscal second quarter results. The box office juggernaut, Star Wars, and increased revenue at its theme parks could not offset slumping sales in its TV unit, especially ESPN. The stock is sinking about 5% in the pre-market trading session. Let's bring in Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. Good to have you this morning, Mark.
Thank you.
All right, so what's the key takeaway from these earnings? Earnings, by the way, were up, but it was just a disappointment from what was expected.
That's the setup for media. It's been under a lot of pressure now for a couple of quarters, and it's become a show-me situation. You're talking about a company that produced double-digit growth. Under a normal scenario, that's fabulous. And it's not egregiously valued at 18 times.
So why is the stock selling off so hard this morning?
You have a couple of controversies around the stock. One is its flagship ESPN unit, obviously, is under some pressure. They're looking for distribution like everybody else, and Iger's trying to negotiate other online forms of distribution and hasn't been successful in converting investors to believe that he's going to be able to do that successfully. And two, he's a controversy in that they had a succession plan in place for a new CEO that fell apart. And as a consequence, either they have to find another one or he decides to stay on in his tenure as CEO and calm investors as to who might take over this wonderful, iconic brand.
I mean, you would think just that uncertainty alone would hurt the stock. So the stock's basically unchanged on the year. And if you look back over the past year, down 3%. So pretty much it's gone nowhere, done nothing.
Well, again, you're talking about a company that was priced at over 20 times earnings. And when companies are priced richly to the market and to even the consumer discretionary space, it really puts the onus on that company to deliver better than expected earnings or deliver expectations that exceed what the market is expecting. And when they don't do that, they're subject to disappointment. And obviously, that's what you're realizing in the price pressure Disney stock is under.
But Mark, is ESPN also going through its own generational change? Top talent that are leaving, internal problems in the network, and your product is your talent, your product is your content, and if that content begins to go away as we see ESPN stores closing, people leaving, does the company need to make a change to become a new version of ESPN?
Clearly, I'm not an expert on whether or not that's likely to be the case.
But does that affect the way this market looks at it?
Yeah, absolutely. Because, I mean, if you think about the franchise of ESPN, there was nothing like it. And now suddenly there's more and more alternatives for you and I to find out what our favorite sports team did, like the Penguins win last night over the Washington Capitals. And so that is a concern, considering how much and how important ESPN represents to the Disney franchise.
How much breathing room do they have in terms of getting a successor in place? How long do you think investors will give them to at least tip the hat as to who's in line? Because they don't even have any. How many names have even been floated to take over for Iger?
Very few. It's been pretty quiet on that front so far. And obviously with news like we've gotten last night and aftermarket from Disney, that timeline is shrinking because obviously the share price is under pressure, down 6% at least on a pre-market basis. We're back down to $100 a share. Fairly reasonably priced, not egregious, but that doesn't mean valuation couldn't get cheaper as a consequence of paying the price of not finding that successor soon.
Price to earnings on the stock right now is less than 20, so it's not like it's that price.
Exactly.
But I want to move on to a couple other names because your other stock picks are interesting. Halliburton is one of them, as well as Pfizer and Chubb. But Halliburton, why?
Well, we think oil prices have found a durable bottom. I mean, that's key. And secondly, we think that oil markets are going to come into balance in the second half of this year. There's been tremendous production destruction as a consequence of low oil prices having stayed low as long as they have. And as a consequence of that, with increasing demand, which is occurring on a global basis, coupled with the amount of production that's been taken offline, particularly in U.S. shale, we think ultimately that bodes well for CapEx out over the next 12 to 18 months. And that should benefit a Halliburton, which is in that space and is primarily North American centered. So if we get production coming back online, as a consequence, they should see the realization.
Just Halliburton, or do you like the sector as a whole?
Like the sector as a whole. I mean, a way to play it is outside of Halliburton more safely, perhaps his own XLE, an ETF that just represents the energy space.
Good stuff. All right, great. Thanks for being here this morning, Mark.
Oh, you're welcome.
All right, Mark Luschini from Janney Montgomery Scott. All right.